Hey investor friends, I'm Michelle Markey, and today I'm going to talk about Danielle Town and Phil Town's 2018 Invested book chapter July on Charlie Munger's fourth principle of investing on pricing. And what this means is we're trying to figure out a price that makes sense to pay for a public company stock. And there's not an infinite price that we should pay for a company or a business. And Charlie Munger has certain principles that he gave in an interview to the BBC some years ago. And I'll just quickly run through them, but I've talked about this in previous videos. And if you want to see these principles in action, please feel free to check out my video on Alibaba and how I try to value that company to figure out a price at which to pay for its stock. And really quickly, the principles that Charlie Munger has outlined, in which the Invested book has gone through in great detail, is we have to have businesses that we're capable of understanding and that gives us meaning, and that it has a moat with intrinsic characteristics that give it a durable competitive advantage. And we need to have a management that has integrity and talent. And then finally, the fourth principle that I'm talking about today is to buy at a margin of safety price, or a price that makes sense. And in July's chapter, we're actually just going to talk about 2 out of 3 of the valuation calculations that we can use. So we're not going to talk about the margin of safety. That one is covered in detail in the August chapter, so I'll get into it next month. But for this month, we'll talk about the owner earnings or 10 cap price, as well as the payback time price to pay for a company. And the company I'm going to use is Apple, because I know it's an industry darling and that's a stock that I'd like to own, but I'd want to own it at a price that makes sense. And then, as Danielle also talked about, we want to buy it at a price that not only is reasonable, but wait until it goes on sale so that we have a reasonable margin of safety built in, which is more or less 50% off what we think is a reasonable price for the company. So I hope you enjoy what I'm talking about today as far as valuation calculations for Apple and my key takeaways from this chapter. If you're like me and are also trying to be the best investor you can be, I'd love if you could please like and subscribe to my video and YouTube channel, because it greatly helps out with YouTube recommending my video to other people, and it lets me know that you're interested in the content that I'm talking about and you might find it helpful. And that's what I'm here to do, is to help you and myself become the best investors we can be. I greatly appreciate it. Thanks. The events and explanation of the Invested book are based in the time frame of the year 2015, when Danielle and Phil were starting their podcast, also called Invested. And back then, Danielle was struggling to figure out how to value public companies so she could figure out what price to pay for their stocks. And she had come from the startup world and being a lawyer, and she was sort of accustomed to how things might work in that world. But when it came to public stocks, this was a whole new world to her. So it was a real ordeal for her to try to figure out how to value companies. And thankfully, her father came out with New York Times best-selling books with Rule Number 1 and Payback Time. And he came up with a total of 3 valuation calculation equations that he taught Danielle how to use. And you may be wondering, why do we have 3 valuation calculations? And that's because Phil said if you have 3 different methods to value a company, it forces you to better understand a company, and you have better options in which to consider if this company is worth buying at a certain price, or if you should keep doing your research and learning until maybe you find out when it's a good time to buy the company at a certain price. And essentially, the 10 cap price is based on Warren Buffett's owner earnings, which I'll explain in a little bit what that means, as well as payback time is based on free cash flow, and then margin of safety is based on earnings. So there are slight variations in how we calculate the value of a company, and they give us a range of prices to consider, how much we would want to buy a company at. So it's a really useful guideline to have not just 1 valuation calculation, but 3 to help us make the best decision. This chapter uses a few different types of examples to explain the valuation calculations of 10 cap and payback time. And specifically, Danielle applies these calculations to a lemonade stand, a rental house, and Whole Foods when it was a public company and before it was bought by Amazon. And she also brought up the examples that Warren Buffett used in his 2013 letter that came out in 2014, where he talked about when he bought his Nebraska farm and real estate in New York. And the 10 cap method comes from a real estate investing term called capitalization rate, or cap rate for short. So for example, if you own a property and you bought it for $300,000 and you can get a 10 cap, that means you get 10% of your return on investment in the first year. So in other words, that's $30,000 off an investment of $300,000 that you would be getting from a property, and that's called a 10 cap because you're getting 10% back on your investment in the first year. And compare that to real estate in really expensive places. Like I've heard Vancouver, Canada's real estate is at a 2 cap, which means if you buy a property for $300K, you might only get $6,000 from that investment. So that means you're only getting a yield of 2% on that investment. So that's a really useful way to kind of think about investing in not only real estate, but also applying that to public company stocks. And it's a really simple way that Buffett loves using as well, because it's based on his definition of owner earnings that's pretty simple to calculate. It's helpful to think of using the 10 cap valuation method as though you're buying an entire business, because it gives you an overall market cap, and we divide that from the total shares outstanding to arrive at a price for the 10 cap. And the formula in the book borrows from Buffett's definition that was from the 1986 annual letter, and I'll just cite a little bit of what he said there, and you can pause the video and read it in more detail if you'd like. But the formula in the book is a little bit more detailed than what Buffett outlines here, which is that he defines owner earnings as reported earnings plus depreciation, amortization, and some other non-cash charges, plus the capitalized expenditures for plant, property, and equipment. And I'll get into an example of how that looks like for Apple based on how the book extrapolates this definition of owner earnings to get the 10 cap valuation. In applying the 10 cap owner earnings equation, I found Apple's 10K annual report from October 2020 from its investor relations page. And you look through the different cash flow statement or income statement numbers to populate these figures that are in this table I outlined here. And I looked for the pre-tax income or net income, plus the depreciation and amortization, plus accounts receivable, plus accounts payable, income tax, and ideally maintenance capital expenditures or CapEx. But I couldn't find, when quickly doing the slide, the maintenance CapEx. So maybe if I try harder to look for it, I could locate what the maintenance amount is, but I just included all of the CapEx. So this is gonna be a little bit of a bigger number, and some of these numbers could be negative, but if they're negative, we just add them in this equation. So we arrive at a total owner earnings, and then we have a market cap based on the fact that we want to get 10% from our investment in Apple. So I come up with a final price of $69.57 per share to pay for Apple. So that's one example of how to do a 10 cap. And if you want to learn more about how to figure out this valuation, definitely check out the Invested book and read this chapter, because it's fantastic in explaining each of the details and what goes into the equation exactly. If you notice, Apple's current stock price is nowhere near that example 10 cap price that I found. And Phil Town says that it's a lot easier to find 10 cap prices in the stock market than your local real estate listings, because borrowing from another set of Warren Buffett quotes, Buffett mentions how the stock market gives you minute-to-minute valuations for your holdings, whereas he has yet to see a quotation for either his Nebraska farm or New York real estate. And the last insight that I want to point out, and otherwise you can pause if you want to read more, is that it should be an enormous advantage for investors in stocks to have those wildly fluctuating valuations placed on their holdings, and for some investors it is. And what Buffett means to say here is that we should consider ourselves very fortunate that the stock market is always putting a price on which we could choose to buy a stock at. And that's not like a farm where maybe the farm might be a certain value, but unless you look at comps in the neighborhood of farms, then maybe you can sort of gauge what the prices tend to be going for. But it's not as transparent as the stock market is for how much to pay for a farm. And that's why we might have an advantage in looking for 10 caps in the stock market compared to real estate. Investors use payback time to put a price on a company that they're not going to sell for a long time. And what this means is we want to figure out the amount of years that it takes to get our whole purchase price back in terms of the company growing its free cash flows at what we consider to be the windage growth rate of the company. So we estimate how much the company is growing on average, and then we use that growth rate amount in compounding its free cash flows to reach a point at which we can take our money out of the company, and then we can just play with house money if we're still invested in the company, but we took out our initial capital that we put into the company, and that's how we get our payback time price. And another way to think about this is the difference in prices for public and private companies is based on how liquid they're considered to be. So public company stocks on the public stock market exchange are considered to be very liquid because people can trade in and out of them very quickly. So that's really important to money managers. But for people like Warren Buffett and Charlie Munger, they don't need to be trading in and out as much. So they're totally happy with paying a private company price for a public company, and that's how we're arriving at an 8-year payback time price. So if we can get our money back in 8 years of owning a public company, then that's how we get a payback time price. So applying the payback time equation is a lot simpler than the 10 cap owner earnings because there's two main factors that we look at, and they include the net cash from operating activities plus capital expenditures, and this includes property, plant, and equipment and other kinds of CapEx. And then this was a negative number in the case of Apple, so when I added that to its net cash, I got a figure of its free cash flow to be $73,365, and this is in millions, so just keep that in mind. And then we multiply that by what I considered its 15% windage growth rate, because that's on average what I kind of think the growth rate might be based on what I saw in a table from Guru Focus, which you can check out the financials of Apple over there. And then when I grew that out across 8 years, I then divided that by the total shares outstanding and arrived at a sale price of $68.41 per share. And like the owner earnings example, this number is really close to what that owner earnings 10 cap price was. And both of these numbers are nowhere near what the current Apple price is. So this means that I gotta wait a little bit longer to be able to buy Apple if I want to buy it the way that Buffett and Munger might buy it at. Danielle encourages the reader to practice pricing different companies and then to reward ourselves by, I would like to consider it as humble bragging to someone who might appreciate that we just use a Buffett style of valuing a company to put a price on which to buy a stock. So I'm going to summarize what I just did for Apple, and you can see here that Apple's current price is around $142 the last I checked, and then for 10 cap owner earnings, the price came out to be $69.57 per share, and payback time price came out to $68.41 per share, and that's at a 15% windage growth rate. If I instead estimated it down to only a 10% windage growth rate, I would have a price be at $54.52 per share. So in essence, I should wait until Apple might go down from its current price of $142 down to $55 to $70 per share, and then maybe that's when I could buy Apple. And I actually wish that I could have bought Apple some years ago, because I recall Phil Town in the July chapter mentioning how Apple was recently at a 10 cap price. So I want to just guess that maybe this was around the time of July 2015. And if we look at this chart, we could see that back then, before Apple was adjusted for its stock split, it was trading at around $120 in July 2015. And now that's gone up to all the way, if we reverse the split, the current price of Apple is around $568 based on today's price. So it's amazing how much Apple went up, and I wasn't interested in Apple 6 years ago, so I wouldn't have bought it back then. But to anyone who did, which includes Phil Town and Buffett, they made off like bandits buying Apple back in those days. And so for the rest of us who are still on the hunt looking to buy Apple, we've still got some time to wait until it might be on sale someday. So I hope this video was helpful to you, and if you enjoyed my video or learned something, please like and subscribe, and I wish you well on your journey to being the best investor you can be. Till next time.